Here's how Federal Reserve head Jerome Powell can resurrect his reputation and avoid a crushing recession. Hello, I'm Steve Forbes, and this is What's Ahead, where you get the insights you need to better navigate these turbulent times. The Federal Reserve Board meets this week. A big boost in interest rates is a foregone conclusion, but afterwards, Fed boss Jerome Powell should take a hard look at what is actually unfolding in the economy, as well as his own assumptions about monetary policy. He can still salvage his crumbling reputation. He was recklessly late in fighting the inflation plaguing us today. Now he's making the opposite mistake. He's overdoing it, thereby plunging us into an unnecessarily severe downturn. No wonder Powell's prestige is crashing faster than the stock of Facebook's parent, Meta Platforms. Even when the pandemic eased and the economy was briskly recovering, the Fed continued to print money at a manic pace. To win White House approval for another term as chairman, Powell also cynically approved the Biden administration's spending binges, which the Fed largely financed by buying buckets of U.S. government bonds, with money created out of thin air. Powell, like all central bankers these days, is convinced that you fight inflation by depressing the economy. A recession will take the pressure off prices, but it doesn't deal with the real root cause of inflation, which is lowering the value of the dollar, usually by printing too many of them. And we're heading for a downturn. What Powell and his cohorts can't comprehend is that there always is a time lag between a change in monetary policy and when it impacts the economy. An analogy would be changing the course of a large tanker. The price of gold, after all, has fallen around 15% in recent months. That kind of a sustained decline is always a signal that money is becoming scarcer. Hardly any economist these days pays any attention to the yellow metal, but many do look at the supply of money in the economy. The most widely used measure is called M2, which includes cash, checking deposits, money market funds, and savings deposits that can be quickly turned into cash. M2 soared an astonishing 40% from September 2019 to year-end 2021, and this surge helped fire up prices. But now, M2 has gone nowhere since last December, signaling harder times after a lead time of 12 to 18 months, which means an official recession will hit in 2023. After this week's meeting, Powell should announce a pause in boosting interest rates, explaining why the economy is headed for a rough time. He should point out that the Fed can't control price changes from supply chain disruptions or the suppression of oil and gas production, dropping an unsubtle hint that Washington should cease its war against fossil fuels. He should also propose a meeting of major finance and central bank officials to stabilize exchange rates. Volatility hurts trade, which further depresses economy. Let's hope Jerome Powell finally gets together a positive act. I'm Steve Forbes. Thanks for listening. Do send in your comments and suggestions. I look forward to being with you soon again.